You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Chris Pomerleau, our today guest with more than 10 years on real estate syndication and lawyer in different commercial spaces on Midwest. Please help me to welcome our guest today. How are you, Chris, today?
I'm awesome, Adam. Thank you very much for having me. I appreciate it.
Thanks so much for being with us today and taking the time. I want to start with you as a syndicator. What was the beginning for you on syndication and commercial spaces, especially you're coming from the low side of it? So what was the beginning for you on real estate?
Yeah, I didn't take the, I wasn't introduced to it through the legal route, believe it or not. I was a practicing attorney, but I basically started investing in single family rentals while I was practicing as an attorney. I wasn't even a real estate attorney, but I started with single family rentals. And then, after 4 years of doing all the work myself and learning the grind, which I'm glad that I did, it was important. I now know what not to do. But I was doing everything myself with my father. And shortly thereafter is when we started in 2017, when we started getting into more multifamily. And it's the whole Burr method that most people know about, but it works just as well with apartments as it does single family homes. And that's what kind of got me interested.
I think you started in the good time on the cycle where I think it's a lot of syndicators learned a lot on the syndication. But what was the upside for you on multifamily versus low?
Well, there's no way that I can argue with that. I was lucky with when we entered. I started at a great time in the cycle. I wish I would have started on apartments in 2013. That would have been great.
Yeah.
But I think I lucked out too, because as we all do, we learn throughout the process, and any mistakes made throughout the process, luckily I had the market to kind of catch some of those mistakes. So I think we've been able to iron out, and obviously we're not perfect, but we've been able to iron out a lot of things throughout the process of a relatively friendly market so that we can help kind of weather through whatever the heck is going on right now.
Okay, so you're based more on I think on the Midwest. You started on Omaha, Nebraska, and you're focused always, and I think Missouri, Nebraska, and that's it. I think. Correct?
We're in 7 states.
Oh,
We're all up and down the Midwest. So we're as far north as Sioux Falls, South Dakota, and we're as far south. I guess we're in Rapid City, which is about the same latitude as Sioux Falls. So we're as far north as South Dakota, and we're as far south as the Dallas-Fort Worth area.
Oh, okay. So do you see an upside for you to focus on because you just said you started on even on Dallas, which means you're starting on South too. But what is you see the upside of your market versus maybe Florida and Texas markets, especially Dallas, because it's really different fundamentals there.
Yeah, I think there are pros and cons to everywhere to invest, but we know the Midwest. We feel comfortable with it, and it may not be as flashy always, although Dallas has obviously caught a lot of traction lately. But it's not going to catch the flashiness that maybe Phoenix will, where you can buy an apartment and then just naturally the next year it's appreciated 25%. We're not going to see that in the Midwest, but we're also not going to see a 25% dip during recession times or any type of situation where the market's changing. We like it. We feel comfortable with it. It's a good place. And in fact, over the last 4 or 5 years, we're seeing a lot of matriculation and the population growth in the Midwest. So we know it, we feel comfortable, and it seems to be a nice, safe, steady play.
I would like to focus here on your specialty in Midwest. What you see, especially after the COVID, what is the really strong market fundamental on the Midwest, which is making the Midwest different than, for example, Atlanta and I'm not gonna say Tennessee because Tennessee can be considered as also as a Midwest, but like what is the difference on Missouri's and Atlanta and Florida making the market is different and more strong in your opinion?
I think a lot of it alludes to what I had just mentioned about it's not as volatile.
Mm,
And I think it's a safer play for us.
mm,
But also, throughout the process of COVID and, speaking of the masterminds and groups that I'm a part of, and, um, you know, we lucked out. And I'm not trying to say that I know people from all over the country. I do, but I don't know every single person. But we didn't have problems through COVID collecting rent.
mm,
There were situations where we did collect, where we had to work with tenants and whatnot. But for the most part, we did not see a problem with collecting rent during COVID. I have heard through all of our research and the people that I've spoken with
mm,
that you're going to get a lot more problems in some other areas. I think another thing is the competition.
mm.
Um, it's
True.
really popular to invest in Atlanta. Now, there are a lot of people there, so there are more opportunities, but with those more opportunities came more investors,
Mm,
came a difficulty in finding deals that would work. So that's another reason we like the Midwest. Now, Dallas is competitive and it's getting to be pretty tough, but it's large enough to where you can help out. Some of these other places we're in, Omaha, Sioux Falls, Kansas City, Des Moines, Lincoln, Wichita, Manhattan,
mm,
Rapid City. These are great, solid fundamentals that we like in the Midwest, but it's also not as competitive because, as I'm speaking with family offices, crowdfunding platforms, um, they like the metrics of the population of the MSA to be over a certain threshold, and a lot of these may not qualify for that, and that's just an internal threshold they've given themselves. It's not really. It certainly doesn't it hasn't shown to affect any of our returns or our success, but so there's just not as much competition, which allows us to be more successful.
I think you mentioned really good point is the physical occupancy. How you see the actual physical occupancy, especially on COVID and before COVID, on, for example, Kansas and Nebraska, Omaha. What you see the actual physical occupancy on this areas now, right now?
Yeah, I struggle sometimes to answer this question only because uh, our approach, our business plan is we're value add. Now, I understand that's a general statement, but it often consists of tenants leaving. A
Mm,
lot of the properties that we're purchasing, they're either not managed or owned correctly, or the business plan doesn't seem to match with what's going on
mm,
locally. So, because of that, we often see a tad dip in occupancy because we're losing tenants, but that actually allows us to then rehab the units, raise the rental rates, raise the income. So a blanket statement on the occupancy is tough to give. Now, the question is, what am I seeing with occupancy on a stabilized asset where we're done with the business plan?
mm.
We're routinely in the mid 90s. There's no issue with that. In fact, the difficulty is we have properties in South Dakota that are 100%. And so
Mm.
it's almost like, okay, that's kind of a problem. Actually, we want to start testing the market, raising rents a little bit.
Yeah.
We haven't had an issue when a property's been stabilized.
Okay, so you mentioned this, and now we're talking about the same issue, which is a market fundamental. But what is the impact you see right now of the current recession on the market fundamentals, especially is not compared to 2008, because in 2008 the main factor was real estate, but now the main factor is energy and the war. But right now, what you see is the actual impact on recession on your day-to-day operation.
Yeah, you know, a lot of the people we follow, the groups we're in, the research that we do, it's kind of unique because you'll hear different perspectives
Mm,
from very smart minds, economists, people who've been in this game for 30 years. You'll hear different answers, but from what I've gathered and I feel comfortable saying is that although I wasn't investing in 2008, it doesn't mean we can't go back and look at what happened. And you know, that was a little bit different as compared to what's going on now, in that right now we're dealing with two major issues. We're dealing with a lack of the workforce, and which is a fall off of a pandemic that nobody had ever really known how to prepare for in this investing sector. And then you throw in the inflation, which is also kind of coming in after COVID. So we're in a situation where generationally, we love multifamily because less and less people are just buying their first home at the age of 20 and then living there the next 40 years. Generations are transient. They're moving around. They may want to work over here. They might want to live over here. And then one of the benefits of COVID, which is a weird thing to say, is that we've learned that you can accomplish a lot of these things from home.
Yeah.
So because of that, and that people still want to be more transient or not locked down in a place that they purchase, like a single family home, multifamily is great. And that's been a benefit for us. The weird thing that happened was this inflation portion.
Yeah.
So now we have multifamily, which is extremely sought after by the people who are living there and now investors, but it's becoming very difficult to find deals that work when your interest rates have gone up 2.5%, 3% in 4 or 5 months. So I don't know if that's the best answer to your question, but there are pros and cons of what's going on. And it's just really unique to dissect what's happening over the last 13 years. Because I don't think anybody could, well, nobody really predicted what would have happened since the COVID situation. It's just affected us in a number of ways.
So how you see the impact this on looking for deals? Do you see that the recession right now in the Midwest impacting the flow of deals, or still you see that the same flow as before?
I think relatively it's the same. And what I mean by that is if it was extremely competitive to invest in the Phoenix market, it's still extremely competitive to invest in the Phoenix market. The question is, are the sellers, how long are they taking to adjust to what's really going on? It doesn't matter if we look in Phoenix or in the Midwest or even in Florida, which, by the way, we have looked in some different areas outside of the Midwest. I'm still not seeing a lot of these sellers realize what's going on, or at least they probably know, but they don't want to admit it. And so they're trying to sell as high as they can. And so what I have seen is when we're lucky enough to find a seller that will admit, for sure, we'll buy it. They'll admit that things are changing and they'll want to sell still high, but a little lower than they wanted just to get off their books, because who knows what's going to happen in 3 months, right? I've also seen sellers say, I want this number, period. I'm not coming down. And we have taken advantage of that sometimes by offering or proposing a seller carry situation.
Seller financing.
Yeah, seller financing, not for the entire deal, although we have been successful at that as well. But we can say, look, I can't get to your numbers. I just can't. Here's my pro forma. You tell me where I'm wrong. And almost always, if you show them pro forma, they have a hard time telling you where you're wrong. They know it's not worth that. But we can say, look, I'm $500,000 short on this. Why don't you carry a note of $500,000 interest only over the next 7 years? And that can be a way I can get to your figure. And surprisingly enough, we've been really, really, really successful at that. Another thing we're doing is assuming loans.
Oh, okay. Yeah.
So we're purchasing properties that aren't worth that today if you bought it with a new loan. But if we can buy a property that has a HUD loan fixed to it for the next 38 years, Freddie, Fannie, a lot of these longer loans, or even a couple local institutions, local banks that allow assumptions, that's a way for us to meet their demand or the seller's request, but still have it make sense on a value and cash flow perspective, because the rate is so dang low because they fixed it 2 or 3 years ago, or 2 years ago, or a year ago even.
That's really smart, especially, but are you able to do this on bridge loan or only in like Freddie and Mac and all of the institutional banks?
I don't know the answer on the bridge loan. I've never assumed a bridge loan. I can tell you, I wouldn't want to assume a bridge loan right now. 98% of our deals are fixed interest rate loans. Like we don't really mess with the floating rates. Now we have a couple and they've been affected through COVID, no question. But actually, other than those two, well, we don't really mess with anything but fixed loans. So I couldn't answer that question for bridge loans.
You mentioned something really interesting, that you're not like you don't like to control all of your business only in real estate, and you're trying to figure out in the business opportunity in other states, like as you mentioned in Florida and Texas. What is the upside for you to go out, and how you think you can manage the properties by the remote model?
Yeah, I think it needs to be strategic. It's not it's not as if I like Miami, and if somebody sent me in a deal in Miami, then I would make it make sense, even though I'm guessing that's extremely difficult to happen, to make sense. It would be more strategic, meaning maybe the person that brought it to us is boots on ground. Maybe they own their own property management company right there in that location, right there in Miami. I'm just using that as an example.
Yeah.
Phoenix, some parts of Florida, even Arkansas, which is I would still consider extremely close. In fact, we've been looking about 6 hours from us, so that's a bad example. But that would be why we start when it happens. If when we invest in a state that's not right through our Midwest corridor, it would be more of the partnerships or strategies we've been able to set up for that specific investment.
So right now, how many properties under management?
We have just short of 2,600 units.
Okay.
Yeah,
So,
about 211 million assets under management.
so what is the business focus right now? Is in B product or C product or A product?
We actually have taken down a lot more A product lately, which is great, but a lot of that has to do with assumptions. We're building as well, which will be an A product. We don't shy away from C. In fact, that's where a lot of the meat on the bone is. It's just that the stars need to align on a lot of those because you have to get good debt, which can be tough. And you need to make sure that if it's going to be a C product, it's at least located in the B neighborhood. You know, we've learned that ourselves. We purchased properties that had a lot of meat on the bone. The problem is you can make it the shiniest apartment in the area, but if everything surrounding it's terrible, then it makes it very difficult to grow. So we're still A to C, but we're just being a lot more selective with our C opportunities.
So how you see right now in the market the spread between the B and C on the cap rate? Like when you're looking, because this was a debate between me and different investors before that right now there's no much spread between the B and C. So what is your current numbers when you're looking for deals to make it work on the C product, especially after stabilizing the actual asset? Because always we're looking for the C to have an adding value and then stabilize the asset. So what is the current, as you see on the market right now, the cap rate for the C product, especially in the Midwest? I think it's different between different cities, but like for example in Kansas and Omaha, what is it?
I mean, yeah, it certainly is different. And us being in 7 states, it differs a little between every state. But I would venture to say that the difference between Class A and Class C cap rates are relatively small in most places I see, which is again kind of relates back to what I said earlier about some sellers not realizing what's going on right now or not wanting to admit. But you know, the cap rate discussion for us is always kind of a unique discussion. I have to have it with a lot of investors, and I've certainly had this discussion on podcasts or groups that I've been in. The cap rate for us doesn't matter that much. And what I mean by that is, sure, we'd like to have it not be, you know, lower than our debt. But when we purchase something, oftentimes the cap rate is extreme. It's lower than the areas because of the way it's currently being operated. So if you were to take we're not buying fully stabilized, maximized NOI properties because those aren't value add. So our cap rates, we may buy a C-class property at like 4.8% cap rate, but that's because they're 40% low on their income. They're 20% too high on their expenses. So the current the current cap rate is not something we typically really care about that much. But basically your question was, am I seeing a big difference? And I'm not. I'm really not.
I think what you mentioned is really beneficial because you are saying, okay, after I stabilize my property, the cap rate is going to be 7, 6.5, and I have to compare this to my interest rate, which is 6, 5, 4, whatever, and you have to find this spread between the cap rate and your interest rate.
I mean, you do, and you don't want your interest rate to be higher.
Yeah. Then you're going to lose.
Yeah. However, The way we look at it and the way that most people would look at this, I'd venture to say, is the cap rate should be from an investor's perspective, the importance of the cap rate is to identify the value of the asset stabilized. That to me is what matters. Because of course, on these value adds, on these properties that are simply not working very well, the cap rate's low, but that doesn't mean there isn't value in the property. It's like buying a business. It's literally what you're doing, but it's like buying a business. There are many people that have been successful in buying an underperforming business and making it succeed. But if they would have decided not to move forward on the old business's financials, then they would have failed to realize the opportunity. So that's why cap rate for me, I get the question all the time, like, are you sure you should buy this? It's only a 4.9 cap rate. And I heard it's 5.5 in that area. And it's like, well, yeah, but this should be performing way better. And therefore it's not really, it's a 4.9 now, but we'll get it to where it should be, if that makes sense.
It's just gonna impact you, I think, on lending side, especially with bridge loan or fixed loan. But eventually, as you mentioned, this is the goal. You find disturbed property to make it better and make a better NOI. So I agree with you on this.
Well, and a lot of our lenders will agree to a certain interest only period where they're not as stressed about the DSCR, or they're not worried about your ability to make monthly payments because you've provided to them your business plan saying that sooner or later it's going to far exceed where it's currently at.
Makes sense. Makes sense. I think my hardest question always in the show is how you define your superpower.
I like that question. You mean what would my superpower be?
Yeah.
I think that well, this isn't the funnest. This is not the most fun superpower or superhero to watch, but I think it's my yearning to just succeed at all costs. I don't want to give myself a superhero name, but I understand that's not as fun as being invisible or being able to fly. But I truly feel, and maybe this is my legal background, I used to be a practicing attorney, is I feel as though in many instances you can find yourself to the correct resolution or the preferred result. And I think oftentimes people may give up. To give you an example, during COVID and or even now in this interest rate environment, we had a couple of business plans where we anticipated at the time of purchase that we would be able to refinance. So our whole approach is buy and hold. So we'll buy a $10 million apartment. We'll make it worth $13 million. And then we'll refinance. All the investors get back their capital. They stay in, they continue to earn cash flow, and we write it off into the sunset. If I would have underwritten that 3 years ago, I would have said, I think we can do this in 48 months. Whereas now with rates hiking, it's going to be closer to 5 years, maybe. Now, luckily for us, we always knew that we could get it done in 2 years, but we told the investors 5 to 7 years because I wanted to make sure they were comfortable with their capital being locked up for 5 to 7 years as opposed to 2 years. But I'm using this as an example of readjusting and making sure we can come up to the best result for everybody. Instead of throwing in the towel or being worried we weren't successful in 2 years, maybe just not taking distributions for 1 quarter, but now your distributions have close to doubled the next one so that we could do the things we needed to. I think sometimes people throw in the towel a little too quickly and kind of give up.
100%. 100%. Mentorship. How you see the impact of the mentorship on your real estate career, and who was your influential mentor so far on your career?
I'm a huge supporter of mentors, coaches. Outside of the million YouTube videos and podcasts and everything I've ever watched, books I've read, those are kind of mentors. Of course, they should be. I started off with a business coach, a guy named Trevor McGregor. I think he's pretty well known in the space because he was actually Joe Fairless's coach. He was great, and he was a combination of all different types of coaches, business, personal, and everything. But he was great. We work with another guy named Rick Farber, who runs an outfit called Growth Guru. And that's really more about how to build a business because we own a handful of businesses. The reason I think it's important is that, and what I've certainly learned, just, full circle back when I said I did 4 single family homes, if I would have had a coach day one, I wouldn't have spent 4 years getting 4 single family homes. I would have been taught how to maybe learn from one, maybe learn from two, but then help move that into where I wanted to be. So you can either teach everything yourself, which takes a lot longer, or you can just learn from the coach, the teacher. It's why you go to school, so.
100%. 100%. I agree on this. I think so much. Thank you so much for being with us today. And my final question will be how the people can follow your success.
I appreciate it. So our group is Levin Wealth Capital. We're on LinkedIn. I'm on LinkedIn, Instagram, all the social media. Chris at levinwealth.com is the email. And I'm always interested in speaking with investors or other people looking to sponsor deals, or really anybody who's interested in the space. I sincerely could talk about it whenever, wherever. We're really excited about it, and we're doing good things. So I appreciate you having me on.
Thanks so much for bringing insight on the Midwest market, and we're really happy to bring you again to the show to talk more about your success on the Midwest and other states.
Thank you. Appreciate it, Adam.
Thank you a lot.